The real key to all of this is combining your variances. So we've got our activity variance or volume variance, and now we're going to add to it a revenue or spending variance, also known as a flexible budget variance. So the difference between actual revenue and our flexible budget revenue is our revenue variance or flexible budget variance. The difference between actual costs and the flexible budget costs is our spending variance, also generically called the flexible budget variance. So let's take a look for Larry what that is going to look like. So here we're comparing the actual results to the flexible budget, and this is the winner right here. This is what we want to see as a manager, because this is going to tell us how much of Larry's brilliance is coming through in the business doing well or not. So when we compare the actual results to the flexible budget, we could see that there's still a favorable revenue variance. That amount, $1,750 favorable revenue variance, is because apparently Larry was not only able to mow more lawns, but charge more on a per lawn basis. That's what the $1,750 represents. The fact that it's favorable means we were able to charge more than we thought. For our spending variances, the wages and salaries and gas and supplies, the fact that there's an unfavorable spending variance means that we spent more per unit than we anticipated, which is a bad thing. With equipment, maintenance, and office and shop utilities, we actually spent less than we had planned on a per unit basis. And then office and shop utilities, I had mentioned before, was partially favorable, but it's a fixed cost, so that deals with cost control. So any change in our actual versus flexible is for fixed costs is based on cost control, because volume doesn't impact fixed costs. So you could see one of our fixed costs was less than we planned, one was more than we planned. Overall, our net operating income is $200 unfavorable. What that means is, based on the actual level of activity, we should have made $66.50, but we only made $64.50. So that means we made less than we should have, which is unfavorable. We like income, so making less than we should have would be unfavorable. That in itself really doesn't give you the full picture of what's going on, so we want to combine them so you can really see what the whole point of all of this is. So most companies are going to compare their actual results to the planning budget, and they're going to get a variance. The goal of a flexible budget is to break up the variance into its two components. So the total variance would be the difference between actual and planning, but we could see that the amount related to spending efficiencies is related to the revenue and spending variance. The amounts related specifically to just changes in volume is your activity or volume variance. What does this do? It allows us to better understand the overall variance. Let me give you an example. So for revenue, the difference between 43 and 37,500 was our original variance that we calculated, which was a 5,500 favorable variance. But why do we have that variance? Well, that's what breaking it up into revenue and spending and activity is all about. $1,750 of the $5,500 variance is because I did a good job at charging higher than budgeted prices. $3,750 of the variance is the result of mowing more lawns. So we have a total variance by comparing actual to planned, but we need to understand why that variance exists. And there's two main reasons why these variances exist. One is because we mow more or less than we planned, fewer or more lawns than we planned. That's the activity variance. And then the other reason is we charge more or less per unit than we planned. So that's why we want to break these up, so we can better understand why the variances exist, and then we can do something about it. I'll do an example on the expense side. So the difference in wages and salaries, 23,500 versus 20,000. Let me get rid of this just to clean it up a bit. That difference is 3,500, and we spent more than budget, so it's unfavorable. Why is it unfavorable? Well, 1,500 of it is because we mowed more lawn, so therefore we would use more cost. But 2,000 of it is the result of apparently paying our employees more than we anticipated. So we want to be able to differentiate between them. Okay, I'll do one more because I want to do one that have an F and a U. So if we look at equipment maintenance, I'll erase this to give me some room. Equipment maintenance, 1,300 versus 1,500 is a 200 favorable variance overall because we spent less than the budget. Why does that 200 favorable variance exist? Well, 150 unfavorable is because we mowed more lawns than anticipated, but 350 favorable is because we apparently did so at a lower rate per lawn. So instead of it costing $3 a lawn, it actually costs less than that. So that's the point of breaking these up so we can see why the variance exists. We have a 200 favorable variance, but why? Well, because we did a good job at cost control. 350 of the variance is because of cost control. Also notice when you have two F's, you add them together to get the overall variance. Same with two U's. But when you have an FU, like we do here, you subtract. So 350 minus the 150 is that 200 total variance, and the bigger one wins. So it's a favorable outweighs the unfavorable, which is why the overall variance is favorable. So again, the whole point of this is to break up our overall variance and understand why it exists. Is it because of changes in activity from the plan, or is it because of cost control or revenue control that's been done by Larry? This just shows you where these variances come from. So the activity variances are 50 lawns extra that we mowed times 75 a lawn. Likewise, our wages and salaries activity variance is the result of the additional 50 lawns times the variable cost per lawn. So the only reason activity variances exist is because we mowed more lawns than we originally planned. The revenue or spending variances are the result of us charging more or less per lawn for our service and then paying more or less per lawn for our costs. Paying more or less per unit, which is a lawn. The difference between the actual and our flexible budget is where we get our revenue variance. And again, that's the result of charging more per lawn than we originally budgeted, which is a good thing. That's why it's favorable. Performance reports are often prepared for cost centers. The same principles apply, except there isn't any revenue or income to deal with. We're just dealing with costs. So we want lower costs than budget. When we're lower than budget, it's a favorable variance. When we spend more than budget, it's unfavorable. In more complex businesses, we may have more than one cost driver, but everything we just learned still applies. So if we have more than one cost driver, then the cost formulas will be a little more complex, but it's not a big deal. You're just going to do the exact same thing except with more than one driver. So we're going to go through an example with Larry. Because the time required for edging and trimming is different for different lawns, Larry decided to add an additional cost driver of hours for the time required for edging and trimming. So Larry estimated the additional hours and developed a new planning and flexible budget. So here is the new budget with an estimated number of lawns being 500 and 100 hours. So revenues are going to be based on 75 a lawn plus $25 per hour. And then the wages and salaries, you could see, are affected by the number of lawns and the hours, and the gas and supplies and equipment maintenance, again, also affected by number of lawns and hours this time. So what's the difference? Well, the difference is in order to get your revenue or your cost, you're just going to have to insert the number of lawns and the number of hours into our formulas. That's all. It's the same exact process, except you have two variables to deal with. To do the flexible budget then, the only difference is you're going to put in the actual number of lawns and the actual number of hours into the formula in order to calculate your flexible budget. So it's the same process where the planning budget is based on the planned number of lawns and planned number of hours, and the flexible budget is based on the actual number of lawns and actual number of hours. And then you can create a performance report the same way you did with one driver. You just do it with two drivers by comparing your actual to your flexible to get your revenue and spending variances, and your flexible to planning to get your activity variances. So the process is exactly the same. It's just a little more math that is involved. Believe it or not, that's all there is to Chapter 9. So that's some nice news. The key to your success in this chapter is practice. I want to give you a brief summary of the important topics that you should be aware of. The planned budget is also known as the static budget, and that's based on planned activity. That's the activity that we figured we would have at the beginning of the period when we created our budget. You have a flexible budget, and that's your budget numbers based on actual activity. The difference between your planned and your flexible budget gives you your activity or volume variance. And then we have, of course, our actual results. And the difference between flexible and actual is going to give us our revenue / spending variances, also known as flexible budget variances. We want to look at our revenue spending variances because that's comparing apples to apples. It's comparing our budget based on actual activity to the actual results. The flexible budget really is the budget we would have created had we known what the actual activity would have been. So these are the variances that we really want to be focusing on in improving the business. The activity or volume variances are the variances that simply exist because I sold more or less than I originally anticipated at the beginning of the period. Work on those practice problems. Practice makes perfect, and you'll find that these questions are relatively easy to answer, I believe, on quizzes and exam questions.